ARK Investments Underperforming. So far, ARK Innovation's macro forecasts have failed. Rising rates hurt costly growth stocks. Forced selling causes large outflows from ARKK. The price of many ARKK assets remains high and may fall further, despite the fact that they have fallen significantly in the recent year. Many of ARK Investments ETFs have declined in value over the past year, including ARK Next Generation Internet, ARKW. These ETFs have had a terrible year in 2022, and the downside is substantial. A rising rate environment coupled with strong inflation might exacerbate the problem for ARK's ETFs. It certainly doesn't help that Cathie Wood has made many high-profile macro predictions that have so far failed. With many of ARK's assets still trading at lofty prices, a swift turnaround appears improbable. This year, ARK's primary ETF, ARKK, has lagged both the overall market and the tech-heavy Nasdaq index. ARK Innovation ETF price and total assets under management are both below high. ARKK's price fell 19% in January, while AUM fell 24%. The ETF's net outflows explain the disparity. ARKK has lost 50% in the past year, while AUM has lost 55%. For ARKK to return to its all-time high, shares would have to double, or grow by 100%, illustrating the recent severe capital destruction. The fintech and internet ETFs have fallen 46%, while the genomics ETF has fallen 56% in value over the previous year. On an AUM basis, all three ETFs are down around 2/3 from their respective early 2020 highs. Several variables explain the massive underperformance. Recall that the general market is up 19% year-on-year. First, macro headwinds exist. Despite anticipation that it would be transitory, inflation has soared in 2021. Inflationary pressures seem unlikely to abate soon. The owner's equivalent rent component of the U.S. Home Price Index is up 17% year-on-year. In the U.S., the Producer Price Index has risen 10% in a year. Companies will attempt to pass on greater costs to consumers. So CPI hikes are unlikely to slow much in the coming months. They may rise more, since producer prices have risen faster than consumer prices, and there is a temporal lag between the two. High inflation contradicts Cathie Wood's deflationary argument. Cathie Wood predicts future deflation, although this hasn't happened yet. Instead, inflation is at a decade high. Not having commodities exposure, for example, energy, mining companies, protects her money against increasing inflation. Instead, her selections seem to provide little or no inflation protection, leaving them exposed in a high inflation scenario. And strong inflation forces the Fed to boost rates further in the coming quarters. Equities discount rates rise with rising interest rates. This has a big effect for pricey growth companies, since future earnings are years away. The ETF's strategy of investing barely profitable or non-profitable growth stocks leaves it sensitive to interest rate hikes. Equities, and notably ARK's costly growth companies, might see more pressure if rates rise from current levels. ARKK, like the other ARK funds, also faces additional challenges. As a result of the outbreak, ARK was able to raise their investments in their preferred stocks. This led to higher share prices for companies like Tesla, TSLA, and Teledoc, TDOC, and higher NAV for the ARK funds. But it only works till it doesn't. As inflows have changed into outflows, ARK Investment has gone from being a net buying to a net seller. In turn, this affects ARK's favorite stock prices, which in turn reduces the net asset value of these ETFs. This causes additional outflows, which causes more forced selling, and so on. In this way, the once virtuous cycle of increasing prices has become a vicious cycle, as falling prices put greater pressure on ARK and its assets. Many ARK stocks are still overvalued. Even if the average ARK stock is down over the past year, several of these options are still expensive. Despite their generally poor one-year performance, several of these firms still have significant downside potential. Contrary to previous ARK selections, Tesla has really risen over the past year. Prices are approximately $1,000 now, down from $1,200 a year ago, but still much above where they will be in the summer of 2021. I think shares are costly. The fact that Tesla has a sales multiple of 13 and an F/EBITDA ratio of 56 means that if sentiment turns negative or markets decline, Tesla will fall too. An EBITDA multiple of 30 would still be a significant premium over other automakers, allowing the stock to fall close to 50% from current levels. Teledoc, another ARK favorite, has had a terrible year, with shares down about 70% from their highs. But Teledoc still trades at a 35 EBITDA multiple, with sluggish growth and limited profitability. The stock might fall further unless sentiment improves dramatically. Teledoc's shares would fall another 30% if it traded at 25x EBITDA, which is still a high value. Berkeley Lights, Nasdaq, BLI, is another ARK selection where I feel shares might fall much lower. Despite a 40% year-to-date decline, the stock remains unattractive. Market value and EBITDA of Berkeley Lights. The firm is still trading at 8x sales, even though it is losing money. For a cash-sucking, extremely unprofitable healthcare firm, the present value is not cheap at all. If sentiment stays low, I predict shares might tumble another 50%. Exact Sciences annual and quarterly revenue. Exact Sciences, EXAS, a diagnostics firm, trades for roughly 8x sales. Despite ARK's concentration on disruptive growth firms, the company's revenue is only rising at 12%. This is not a cheap value for a firm that is not profitable. EXAS shows negative EBITDA, and grows at just over 10%. Spotify, Block, Twilio, and Roku have to EBITDA. Last year, Spotify, Spot, Block, Square, Twilio, TWLO, and Roku, ROKU, all saw significant price declines. Nothing here seems very cheap. I don't think there's a fundamental reason why these equities can't fall more. Why shouldn't Spotify's EBITDA multiple fall to 100, 80, 50, or even lower if growth stock sentiment continues weak? The same goes for the other equities in the chart above, which might all tumble another 20%, 30%, or more. Of course, it doesn't mean they will. I also don't want to gamble on it since I'm not short any of the companies listed here. Just to highlight how expensive many ARK choices are despite their poor performance. This suggests that the ARK ETFs and individual equities are at danger of future price losses. There are certain growth names that seem to be inherently cheap. Meta versus Alpha, EV/EBITDA/revenue. And Meta Platforms, FB, and Alphabet, GOOG, are expanding faster than many of the ARK brands. I am certain that these equities, with strong growth prospects and low valuation, will not fall 30% or more from their present levels until a massive bear market occurs. Unlike FB and GOOG, Spotify and other ARK names are very costly. Spotify's recent sales growth rate has been in the high 20s, making it a slower growing stock than Meta and Alphabet, but it trades at a 900% premium to their EBITDA. The ARK funds, notably ARKK, have had a horrible year and especially a bad month. Bad macro predictions. Cathie Wood anticipates deflation as inflation is at a 40-year high, and forced selling in several ARK names may cause more down. Fundamentally, I see no reason to think these ETFs can't fall further. Many holdings remain expensive. If growth stock sentiment stays bad and these ETFs continue to lose money, investors may want to avoid ARKK and the other ARK funds. Don't just buy Bitcoin, earn it with blockfi. When you spend with blockfi, you can earn up to 3.5% back.